We're talking about the Wellington real estate market, of course, and looking at the numbers that came out throughout or for the month of March, and compare that to recent years, back over the last 15 years or so, trying to identify the patterns and so on. But look, in summary, folks, Wellington values are down again. In last month's call, identified that values had gone up in February. And that was kind of against the general trend. We'd seen values softening generally over the last year or so. And then February all of a sudden popped up. One data point doesn't make a trend. And so the next data point in March has dropped back down again. So that was a bit of an aberration, the February market. My sense is that it was simply that there was, as is typically the case at the start of the year, really slow for the new listings to come on in the new year. There's always a bank of sellers waiting to come on in the new year. But inevitably in the new year rush, there's always delays and people, take time in getting their arms around their plans and so on. So the ones who are really well organized are on the market quickly, and the buyers, when they come back from holiday, the buyers kind of come into the market, and there's a whole wave of new buyers, and there's not a whole wave of new sellers. Well, there is, but they're getting ready, and that takes time for the supply to come on. So for the first 2, 4, 6 weeks of the market, you get quite a strong market, and it's those vendors who are well organized and had their property ready to go. And typically how we try and handle that is we have them ready to go and we do all the work before Christmas. Then we go on holiday and we come back and we simply press the button when everyone else is painting or getting their house ready, and then taking photos and getting the marketing ready and doing all that stuff. Anyway, message to sellers is there has been a lot of supply, and that makes it tough, of course, to compete for the buyers. You've got a lot of competing listings trying to get the attention of the buyers, so that makes it hard work. The ones who are most committed, the ones who present their property the best, and the ones who are priced sensibly are the ones that get the buyers' attention. Everything else struggles or can struggle and languish on the market. That, of course, makes conditions really good for buyers. There is massive choice out there. You will see that we are now starting to see supply come back down again. Again, typically is the case, as soon as daylight savings comes off, the flow of new listings coming to the market takes a step downwards, because psychologically vendors think the sun goes down earlier, my property doesn't look as good, whatever, the weather's not as good, people won't be in as good a mood, and so on. So the supply of listings coming to the market slows down. Ironically, that is what starts to make selling conditions better. And so what we actually find is that throughout winter, we start selling the stock that was sticking and has been on the market for some time, because the amount of supply, the choice for the buyers, thins out a bit. So when the good stuff sells, then people have to consider grade B and grade C stock again. So it's rather counterintuitive. Anyway, let's start to look at the detail. So here's median sale price, 800,000 in March versus 820 a year ago. That's down 2%. I wouldn't pay too much attention. Down 2%, down, up 1%, down 4%, up 5%, bouncing around. We've been bouncing around the bottom. The median sale price is a poor indicator if you want to be technically correct, but the trend, the pattern is still instructive. And broadly speaking, you can see it has been largely flat for coming up 3 years now. So the tough market started in about winter 2021. The technical peak in terms of values was October 2021. Activity levels always drop away before prices peak, and then prices start dropping away. So activity levels lead prices. And so we saw, as you can see in the graph there, the red line showing the 6-month moving average, that we've been broadly stable since about July 2022. So it fell very quickly from the end of 2021. Only took about 9 or 10 months to basically get down to where we are now, plus or minus 5%. And it's been bouncing around the side ever since. So we've been bouncing on the bottom for 2 3/4 years now. the best guide to underlying values, if you want to be technically correct on the value side of things, is Real Estate Institute's House Price Index, and that is represented in this chart here. So this is what I've been calling the league tables, and Wellington has been the biggest loser, to quote a reality TV show, for a long time here, looking at this table. So this is the column on the right there. What is the current values compared to the peak late in 2021? And we're down nearly 25%. And we've been bouncing around that number for some time. We got down to as low as about 26% down. We recovered to about 20% down, and then we've gone down and up and down again. So yeah, 24.5% down versus Auckland's nearly 21 versus the country just over 15%. And just let someone else in. Yeah, so it's been a consistent trend. Wellington has definitely been hit harder in terms of the gross degree of the fall, but from the peak to the trough. Now, is that because we had a bigger peak? I don't think so, personally. I think that the cities generally have been out of favour since COVID. Auckland, you can see there, has also been, it's basically the second part of the country, or the part of the country that's in biggest loser number 2. So the big cities are the ones with the biggest losers. Christchurch is not one of the bigger losers for different reasons. That's particular to Christchurch. And Wellington, one of the reasons why Wellington's number is worse than Auckland's will be because of what's happening locally here in Wellington in terms of the public sector labour market, for example. So we are struggling in ways that other places aren't in terms of our unemployment. And unemployment has increased more than in other parts of the country. Anyway, moving on, over the last year, again, in February, we recovered a bit. And so we were no longer the biggest loser over the last 12 months. Well, in the year to March, we're back to that biggest loser position again. And interesting, you see there down in Southland, they are not losing at all. They're reaching new highs. They've seen 4.5% growth over the last year, 2.5% over the last 3 months. So they're going from strength to strength. And generally, the South Island have been doing better than the North Island. But Wellington, 4% down over the last 12 months versus negative 0.7 in Auckland and New Zealand. And so again, over the last 12 months, just like since the peak, we are the biggest loser. And over the last 3 months, unfortunately, I'm afraid to say the same thing applies. So look, the Wellington market has been a consistently poor performer over the last, since we came off the peak in late 2021. Now, if you look now at the different parts of Wellington, now if you follow these calls, you'll know that the 4 territorial authorities you see there, Porua, Upper and Lower Huts, and Wellington City, they are 4 of the territorial authorities that make up the 8 territorial authorities that comprise the overall Wellington region that we're seeing there. And so that's why sometimes you look at the data for those 4 TAs and it doesn't quite add up with the whole region, because there are 4 others that aren't included in there. And that is Kapiti, Southern Wairarapa, Carterton and Masterton. So basically Kapiti and the whole of Wairarapa. But with Porua, the 2 huts in Wellington City, we have the largest portion of the Wellington region. But anyway, there you can see the graph there. The orange line is the 3-month cumulative value movement. So you can see coming out of the peak in 2021, we really started going south in late 2021. We went south very, very quickly, as you can see here, losing up to 10% value in just a 3-month period in sort of early-ish 2022. Then the price drops eased significantly till late 2022, and we've been broadly sort of up a bit, down a bit ever since then. You see here the peak, the jump up that that I talked about in February. So we saw some recovery late in 2024 as we recovered from labour market softness, massive supply coming to the market after the election, and that started to slow down. So we started recovering a little bit at the end of last year. That then eased right at the end of the year. We bounced up in February and then back down again in March. So you can see there over the last 12 months, the whole of Wellington, all regions have gone backwards, but look, pretty poor showing there from Wellington City in particular. Again, sort of makes sense for two reasons. One is the city is out of favour since COVID, and secondly, Wellington City would have a high concentration of public sector labour force, which has been hammered somewhat over the last 18 months or so since the election. But all parts of Wellington region have suffered over the last 12 months. Over the last 3 months, varying degrees there, and Porirua City showing a positive outcome there. Excuse me while I get someone else in here. Again, if you look at 3 month results, they bounce around more than the 1 year results, and the 1 month results bounce around a lot. So whilst Porirua saw a growth of 0.6% over the last 3 months, over the last 1 month it's down by 3%. So don't pay too much attention to the individual data points here. The trends are far more instructive. And there's Wellington City. So the shape of that graph, it tends to be a bit more erratic. More of a sawtooth up and down, more variability because, again, it's a smaller data set. Although it is still quite significant, it's a substantial data set still, but just smaller than the whole region, of course. We tend to see slightly deeper troughs, slightly higher peaks, but the overall pattern does tend to follow very similar fashion to the region overall. And again, you can see there we bounced up in February, had quite a strong result in February, but down again in March, and you can see there down nearly 2% in March, just over 1% in the last 3 months. So yeah, look, there's no question Wellington values have been weak over the last 12 months or so. Number of new listings coming to the market. So this is new supply. Now that's different from overall supply, of course, but if you think like a buyer, what a buyer is interested in every week is what are the new listings. I've checked the market out. I want to see the new stuff this week. And so this is what that shows. The blue bar chart is the monthly results, and the red is the 6-month average. And so interesting to see massive swings in new supply coming to market from enormous amounts of supply coming on late 2021, early to mid 2022, late 2022. It really started tailing off as vendors saw and observed that properties were not selling, prices were falling precipitously. It was a really risky game selling your property, so not for the faint-hearted. So therefore, don't do it unless you're very serious about achieving a result and you're going to really go out there and swing the bat hard at the ball. There was very little testing of the market going on, and then the amount of new supply coming on came right down to levels we have not seen in the last 10 years, certainly, and levels significantly lower than we saw even when the market was shutting down for periods in COVID lockdowns. So really the market was being starved of new supply. That, of course, drove an improvement in the market. Then the election happened, and after the election, people seeing results becoming quite good again in terms of selling houses. The duration to sell was reducing. People were affecting sales. Prices were recovering a little bit. People were encouraged, but they didn't list their properties until the election was out of the way. So then the election came, and a whole new wave of properties came to the market. So you can see there, huge increase from only just over 400 on average per month, late 2023, October, when the election happened, up to almost 800 on average per month in sort of middle 2024, and then tailed off again. With a big increase, of course, you can see there February and March, the blue bar chart bounces right back up again. Quite a strong listing volume in March, probably the strongest number of listings, the largest number of new listings we've seen in the market since way back here in early 2022. So a lot of new listings coming to the market in March. As you can see there, 929 versus 878 a year ago and 663 2 years ago. So 40% more than 2 years ago. It's a big increase in terms of new supply coming to the market, but you can see the overall patterns there. It's really been down, then up, then down, then up again. And there is the March average. 871 is the average for March. And so at 929, yes, it's a lot of listings, and it's a lot of listings. It's a lot of listings compared to the recent past, and it's also a lot of listings compared to what is typical in March. Not by a huge amount, but by a bit of a margin at least. So more listings come to the market in March than is typical for that month. And there is another format. So you can see there, we were 12 months ago, we were seeing way more listings coming to the market than the previous year. And more recently, we've been seeing more comparable. So we are ahead of where we were a year ago, but only by a small margin. What about number of sales? So 781 versus 722, 8% more than a year ago, and 609, 28% more than 2 years ago. And again, if you look at that bar chart there, you'll see there that number of sales taking place in March was not as many as this month here, which is November 2024, November last year. But other than that month, this is the biggest month of sales than we've seen since way back here in, I think that's November 2021. So we have seen there's a lot of sales in March compared to the last 3 years, compared to this slow period. But still not back up to March's normal levels of sales. So that does go to show how starved we have been of sales. The number of sales that we saw taking place really dropped down to very low levels. As you can see here by the red line, in a normal sort of a market, we tend to operate between 600 and 800 sales a month. It was bouncing around in there for a long time. 2021, the peak happened. The number of sales just dropped right down to around about the 500 mark on average. We bounced around there for about a year. And then since mid-2023, so coming up 2 years ago, we've been gradually increasing the number of sales taking place. You can see that red line slowly creeping up. It's been slow, but it has been relatively consistent. But the March's number is a really positive showing. But even at that number, 781 doesn't quite match up to what is normal in a typical market for March. Again, there is in another form compared to 12 months ago. So more than last month, more than last March, but not by all that much. How long does it take to sell? So 36 days in March versus 36 a year ago, so identical to last March. 49 days 2 years ago, so 27% down compared to 2 years ago. At 36 days, you can see by the blue bar chart there, it's a lot shorter duration to sell than we have seen for maybe 18 months or something, 15 to 18 months. But it's still a few days longer than is typical in March. So you can see in March last year, we were the same. We were around here. In March the year before, we were way up here, like 50 days. So well, you can see there, 49. So yeah, and again, the pattern you can see coming out of the peak market into 2022, it became much harder. So the duration to sell leapt right up, and then it came down again as we approached the election because the market was starved of supply. And then it deteriorated again basically throughout 2024 as people brought their properties to the market and made things more difficult again for sellers after the election. But the last couple of months, it's come down again from the highs of January. So look, 36 days, it's longish, but not that long, and certainly not as long as we've seen typically over the last 15 months or so. So on that basis, it's sort of gotten a bit better. Inventory, 16 weeks worth of supply versus 13 a year ago and 16 2 years ago. Again, if you look at the trend, that's probably more instructive than the individual data points. The inventory levels have been creeping up over the last 15 months or so. It is normal to be at 15. When I say normal, I mean the long-term average over the last 15 or 20 years or something. It doesn't feel like a normal market because at 16 weeks, we're barely more than what's the long-term average at 15. But That probably is because over the last 10 years, the average is just over 10 weeks. So 16 weeks is considerably longer than 10 weeks. But interesting, isn't it, that the long-term average, 15 weeks, is pretty much where we are now. So by that metric, at least, we are operating in a broadly balanced market, according to the inventory, at least. Listings, this is gross amount of supply on the market on TradeMe, 3,331 as of a few days ago, versus 3,040 a year ago, 2,765 2 years ago. And so you can see the trends there. We had a huge increase coming out of the boom, and then again, as I've described, the supply tailed off as we headed into the election. And then since the election, generally, it's been going upwards again with the normal seasonal sort of ups and downs a little bit. So in the last month, from March to April, you'll see there that the amount of supply on TradeMe has come down again for the first time this year. Back in March, we were at highs that we haven't seen for about 10 years, all the way back in April 2015. In April this year, we have started, a small reduction, and that will be because, as I indicated earlier on, typical for the seasonal side of things, as we come off out of summer and we come off daylight savings, the supply coming on the market tails off a bit. And so the good news for sellers is if it follows a typical path, we will see fewer properties coming to the market than are selling or being taken off the market. And so supply will come down as we go through winter, only to recover again, perhaps starting in September. So yep, we're still at, this is still large amounts of supply that, broadly speaking, we haven't seen for 10 years or so. And there it is in another format again compared to 12 months ago. So we're still ahead of where we were a year ago, but we are ahead by a lesser amount. The degree to which we're ahead is declining. So in summary, folks, Wellington values are down versus 12 months ago, especially the case in Wellington City. New listings are up versus 12 months ago, but only just. Sales volumes are up versus a year ago, and particularly strong in March, although still not quite up to what would be typically the case for the month of March. But the encouraging thing with sales volumes is it has been gradually but consistently increasing over the last almost 2 years now. Duration to sell is up, but roughly to normal levels. So at 36 days, it is only slightly longer than normal. Inventory is the same as 12 months ago, but down in recent months. TradeMe listings are up generally since a year ago, but again, down in April versus March, as is often seasonally the case as we come out of daylight savings. As I've been saying, the message to sellers is that, yep, values have been soft over the last year, and they've softened in March just because too much supply. And hopefully, from the seller side of things, hopefully that supply coming to market will now slow down. And the buyers' messages, there's still a huge amount to choose from. This is an amazing, amazing opportunity to have less competing buyers and greater choice. So I think if you've got the appetite to buy and you have the capacity to buy and it's affordable, then I would take the opportunity to go ahead and get yourself a property that meets more of what you're looking for, puts more ticks in the boxes than you would otherwise most likely achieve in a more competitive market. So yep, that's it. Big thanks, of course, to Real Estate Institute and realestate.co.nz, where I get all my data from. And thanks to you guys for checking in, but happy to take questions or discuss anything that you want to. Just sing out.
Hi, Adam. How are you?
Hi, is that Monica?
Yes, it is.
Hi, Monica.
My query is, with so much supply, are sellers for the most part realistic? Are you getting a couple of offers a house? I only query this because I know my sister-in-law's looking and she keeps getting pipped at the post.
Right.
Obviously, she's looking at the lower end of the market.
Yep. Okay. Okay, good. So a couple of things on what you said there. Firstly, the segment of the market she's looking at is the lower end. Is she looking in Wellington City or
Yes.
whereabouts?
Yep.
Wellington
Townhouse,
City.
Warrington City sort of
Yeah.
now. Oh,
So the busiest segment of the market is first home buyers,
yep.
the affordable end of the market. Our data at Low and Co, and I don't have it exactly in front of me right now, but if I recall correctly, we are seeing not quite on average two offers. So it's like 1 3/4 or
Yep.
1.8 or something like that, per property, but not on tender day.
Okay.
A bit less than two offers per property throughout the entire campaign from when it comes on to when it comes off. So that's not many, less than two.
Yep.
So if your sister is making offers on deadline day, on tender day, and she continues to miss out, then I dare say she is pursuing the properties that everybody else wants because
Yep.
it's certainly not the norm to have a property have 2, 3, 4, 5 offers. Now, the other day, I know last week we had one property that had 15 offers.
Wow.
So you do get those ones for the ones that are presented well and priced really competitively.
Yep.
They attract all the attention. So if your sister's missing out, then she is pursuing properties that everyone else is too. And that means it's the ones that are checking all the boxes, the popular ones, well presented, sort of I guess a modest sort of a size so that it's big enough to be comfortable, but not too big to be a waste of space and a waste of budget.
Yep.
No issues, popular locations, low maintenance, well presented, well maintained kind of properties that are priced competitively. So it's always been the case, even in a buyer's market, which we're in, that if you are pursuing those properties which are really popular, you have to beat the other buyers.
Yeah.
So you have to make your offers really competitive. Either that or you go to the properties that are not quite as busy, not quite as popular. Perhaps go to the properties which aren't priced as keenly because they will get less. This is the irony of it. The properties that are priced very competitively, that appear to offer really high value, attract all the attention and end up selling significantly above that number. The ones that are priced not so competitively get less of the attention. They are starved of competition, and so they risk selling at a price less than they could otherwise achieve. So these are either the agents that don't know how to communicate that and gain the trust of their vendors in order to execute that strategy, or people who just don't understand that psychology, whatever the case might be. So perhaps start looking at properties that aren't presented as well, or properties that aren't priced as keenly because they will attract less attention.
Thank you. I'll take that back to her.
Yeah, good luck.
Hey, Adam,
Anything?
it's Stephen.
Hi, Stephen.
Hank, hi. In terms of buyers, I'm interested in your views versus investors looking for properties versus, say, home buyers, not necessarily first home buyers, but say looking for home and income.
Yep. Okay, so are you asking how is the market for investors, in particular buyers? Are there buyers out there looking for investment properties? And the same question for home and income?
Yes.
Yeah.
Yes.
So broadly speaking, investors are largely absent from the market as buyers, and the reasons for that are obvious. They have been crushed by the tax rules, which we know now have been unwound, but they are still having to digest and get their arms around and pay their tax bills, and will continue to have to do so for the next 12 months as they pay the 2025 tax bill, which only allowed 80% of mortgage tax relief. Then, of course, they had interest rates which skyrocketed. They've come back down again, I understand, but again, you've got to get over that hump. Thirdly, you've had insurance costs absolutely skyrocketing, and you've had council rates absolutely skyrocketing. And then more recently in the last 12 months or so, and particularly the case this year, the rental market is really struggling, and so rents are softening, in particular in the student segment of the market, where people are having to drop their rents 20, 30, 40%, sometimes even more, and sometimes still failing to attract tenants. So all of these blows, just one after the other, after the other, after the other, are killing investors. Very few people have got capacity or the appetite or both to go out and buy more. So those people who are very well capitalized, there is amazing opportunity to buy counter-cyclically, but there are just not many of them who are able to. So you have more investors who are keen to sell because they're on the floor bleeding, than you are looking to buy. Now, obviously, I'm talking generally. There are always exceptions to the rule, but I'm talking on average here. So I'm not sure if that answers your question. But if it's a typical investment property that you're talking about, like 3 flats in Newtown, for example, no homeowner wants to buy that. Some people would say, but the smart owners should. They should go and buy it and live in one and rent the other two. And that's true, but for the most part, people don't buy homes logically. They buy homes emotionally. Again, always exceptions to the rule, but generally speaking, no homeowner wants to buy 3 flats in Newtown to live in it. Your other question then relates to home and income properties. Now, I'm not a mortgage broker, and so I'm not across the absolute latest of the finance market. But again, overall, your typical buyer who's looking for a home isn't as keen on a home and income as they are on just a home. And there are a number of reasons for that. And they include things like loss of privacy, noise. If you've got people downstairs, then there's always noise. And so, that's related to privacy, of course. And the other thing is, I believe, because you still have the different ratios of borrowing that you can borrow for an investment property. Gosh, we've still got people coming into the waiting room. Hang on a sec. As I was saying, yeah, so if part of your purchase is for an investment property, the amount of deposit you need jumps up a whole step. And so if someone is in the market for $1 million property and they've got, say, a $200,000 deposit, you can go ahead and get an $800,000 loan to buy $1 million freestanding house that is entirely your home. If you're buying a property that's a home and income for $1 million, and $700,000 of that is for your home, and $300,000 is for the 1-bedroom flat, well, you can get an 8% mortgage on the 70%. This is how I believe it works, but I'm not a mortgage broker. And you need 30% or whatever it is, 35% on the 300,000. So $200,000 is no longer enough. So ironically, if you want to buy the property with the income, you need a bigger deposit. Now, some of that will be unwound because they'll take the income from the flat and all those sorts of things. So it's not quite as simple as that. But you can see the point is that to get the home and income, you usually need an increased deposit. And compared to the comfort of the home that you could buy if it was just a home, you'll need to take a significant step down in the quality of your home, your accommodation, your lifestyle to buy the home and income. And so your average buyer does that calculation and goes, nah, it's not worth it. And so we see sometimes, I know that just recently my colleague, for example, sold within reasonably short space of time, sold 2 properties in Lower Bay. One was a smallish home, but it was very cute. 3-bedroom home, modest sort of size. And I'm just roughly presenting the numbers here and the concept. And it sold for about 1.2 million. Cute, really nice and cute. And then a home around the corner that was a 4-bedroom home with a separate standalone 1-bedroom flat, larger home on its own than the other one. and it had in addition a 1-bedroom flat as well, and it sold for less. It wasn't as cute, but also you look at the two and you'd go, surely that home with a separate 1-bedroom cottage standing at the back, all in good condition, that's got to be worth more than the other one. No, other way around. So home and income properties are also, they're not as strong as just standalone houses.
Yeah, so that's helpful. And your summary to my first point about investors, given that's what we are, yeah, the last few years we've basically run life support with all those things that you've outlined very accurately.
Totally, yeah. We're all on life support. We're all like stranded in the desert, desperate for a drink of water, crawling along the sand. And any little drop of water that falls from the sky just seems to get absorbed into the ground. It's pretty hard work out there for us investors for sure. Yep. Very good. Thanks, Stephen. Anything else for anybody else? No, it sounds like it might be all. So, yep, that's all good. Thanks, everyone. And anyone needs any individual advice or whatever, happy to talk, reach out. I know that there are people out there that are struggling with the investment properties and so on. Things still can be sold. If you want to talk about that, then let me know. But it is really important how you manage it and which ones you select to sell to make sure that you're maximizing the chance of success and unlocking, of course, as much capital as possible with minimal downside in terms of loss of income. But yeah, just reach out if you need any individual advice. Happy to help. All right. Otherwise, take care. Thanks for checking in and see you next time.